Morning, this Tuesday morning. It's time to do business. I'm Ini John Mekwa. As usual, we start from the global space where oil prices fell for a second day in early trade on Tuesday on worries that United States tariffs on Canada, Mexico and China would slow economies around the world and hurt energy demand, while OPEC Plus ramps up its supply. For this morning, 29 cents shaved off Brent. That's what we have. That's equal to 0.42%. So it's now at $68.99. Now look closely, you would see that about this time yesterday we had about $70 there, but we've lost almost $2 in less than 24 hours. WTI is also down 0.55% at $65.67 a barrel. Now you wonder what this does to Nigeria's revenue, seeing that this is a major contributor to Nigeria's revenue. And look at the budget that has a target of $75. So I guess the government will have to start thinking fast on how to cover up for this. I guess the easiest way would be increasing crude, even though we're already targeting more than 2 million, which we have not hit. And talking about Nigeria and what's going on in the oil and gas space, the Nigerian National Petroleum Company Limited has debunked reports that it unilaterally ended its crude oil sales agreement with Dangote. It explains that the contract, which allows crude purchases in Naira, was a 6-month deal expiring in March. That's this month, with discussions ongoing for a renewal. NNPC states that since October 2024, it has supplied Dangote refinery with over 48 million barrels of crude oil, bringing the total to more than 84 million barrels since operations began in 2023. The company has assured its continued commitment to crude supply for local refining under mutually agreed terms. Well, closely related to that, the committee in charge of the crude for Naira sales have also saying that the report suggesting that the Naira-based crude oil supply arrangement with local refineries has been discontinued, forcing them to rely solely on international crude purchases, that they do not reflect the realities of ongoing work under the Federal Executive Council initiative on domestic sales of crude oil and refined products in Naira. The committee says it's driving the implementation of this initiative, and they wish to provide updates on the Federal Executive Council initiative and confirm the following: like the Naira-based domestic sales framework remains in place, that the policy framework enabling the sale of crude oil in Naira for domestic refining remains in force. The initiative was designed to ensure supply stability and optimize the utilization of local refining capacity, and there's been no decision at the policy level to discontinue this approach, nor is it being considered. So we'll see what happens at the end of this month when, according to NNPC, that first expiration is supposed to come, and we'll see if there'll be an extension to that. Now, also still in the oil and gas space, that space was really busy late yesterday. The Petroleum Products Retail Outlet Owners Association of Nigeria, that's PETROAN, they are calling for healthy competition and price stability in the downstream sector. In a statement released by PETROAN, they lay emphasis on the importance of preventing monopolies and ensuring local refineries thrive, given their significant economic benefits to the country. To achieve this, PETROAN is recommending a multiplicity of supply sources, including Dangote Refinery, NNPC Refinery, Modular Refinery, as well as imports. Well, according to PETROAN, this diverse range of sources will foster competition, especially with imports, allowing for comparisons with international market prices and protecting the local markets from exploitation. A whole lot happening right there, and we'll settle on that conversation in just a bit. But before then, the Minister of Budget and Economic Planning was in Lagos yesterday, met with some business editors. Unfortunately, I wasn't there because I was with you here in the studio, but we have excerpts from that on some of the high points of the conversation they had.
The renewed hope agenda of Mr. President. The philosophy is let us confront our reality. That reality being we are not where we want to be.
The Minister of Budget and Economic Planning, Mr. Bubakar Bagudu, is meeting with business editors in Lagos to reveal the mind and reasons for some decisions which the President Bola Tinubu's administration has taken and is taking to fulfill the vision of the President for the country.
How can we ensure that we are investing the little that we have in those areas that will restore macroeconomic stability, restore security, provide food security, restore infrastructure growth, restore innovation in the economy, invest in human capital, as well as social protection. And the budget is intended to achieve that. More money is being spent on the security sector, defense, because we have seen a lot of security gains across the country.
The minister is proud of some gains, which he says includes reduced security threats, which has led to an increase in crude production and food production.
Further cement those gains, 1.5 trillion naira is being provided to recapitalize the Bank of Agriculture. Another 500 billion to recapitalize, to provide additional capital to Bank of Industry, even though they have been running the bank very well. They are even raising money on Eurobond, but the government decided that we should strengthen the bank with more capital. We have put in the budget 1 trillion naira to support solid minerals because it's the quickest addition after agriculture.
Mr. Bagudu also speaks on debt servicing, saying that revenue increase to debt servicing is just an option available to the government, but the need to expand the economy as quickly as possible is more important than paying off debts. So you're still watching Business Morning right here, and yes, we saw the minister there justifying some of the decisions that the present administration has made and the plans, and the issue of debt servicing there. I'll leave that for another day, I guess, as they say, that's a topic for another day. But for today, let's settle on those things that have been happening in the oil and gas sector. We saw a lot of releases and all of that. One of them from PETROAN. And in PETROAN's release, they seem to have the fears of monopolies and, of course, talking about ensuring that local refineries thrive. And we're talking about monopolies. They said that they recommend multiplicity of supply sources, which will have Dangote refinery, NNPC refineries, modular refineries, and imports. So let's find out why they have these options with the president of Petroleum Products Retail Outlet Owners Association of Nigeria, Mr. Billy Gillis Harris, joins us from our Abuja studio. Mr. Harry, good morning and welcome to the program.
And thank you for having us.
Great. So yesterday was really busy. One of the things that made it busy is your release. Where what is at the bottom of this? What motivated your release yesterday? Because we hear you talk about monopoly, crude to local refineries, the need to have multiple sources of products. What motivated your release yesterday?
My members are buying product from every possible source, and the size of losses anticipated by unstable prices can only be imagined. And in our consistent weekly reviews, we discovered that the size of loss and the possibility of most of us getting out of business was glaring at us in the face. And of course, in today's Nigeria, we have collaborative efforts that's been made between all the stakeholders. And we reach out to one another to know how our businesses are doing, because as much as we are making efforts to ensure that Nigerians have product affordability from our end as the last mile in the industry, we also want to stay afloat in being liquid. So this challenge we have is that we buy products today at a certain price, and then before close of day, the prices have reduced. So we thought there should be a mechanism by which this price fluctuation should be, analyzed and ensure that it doesn't impact negatively on the industry.
Okay, but one would have thought that perhaps that when you talk of the mechanism, what would it look like that the price of global oil should be able to take care of that?
I've always said that every business can only survive making some minimal profit that is commensurate to paying the cost of doing business. And we are fully aware that the international prices of crude oil and other related, expenses are also, being reduced. But when we invest to buy products, say, at about 890 naira and land it in our station with maybe additional 10, 15 naira more, you are not going to expect us to sell less than that. And if that same product suddenly becomes reduced to 840 naira or 860 or 870, it becomes worrisome how we are going to recover the cost of our money. And that's what we consistently review, and churned out this advice to the industry so that we can all be on the same page and nobody should be left out, left behind.
You voice your fears against monopolies. Of course, I don't think that's healthy for any country at all. But when you add to the mix importing petroleum products, when they're supposed to be produced in Nigeria, that, brings up some questions. Why?
Well, we have been at the forefront of always implementing what the stakeholders agree. We have capacity to do our imports. We have capacity to buy products locally refined, and we insist that it should be so. But however, if consistently we are seeing that prices shift up or shift down, and there are no clear business consultations of how this should be done to the benefit of Nigerians, which is why we said that the NMDPRA and the Consumer Protection Agency should swing into action and be able to work collaboratively with all the stakeholders so that we can have a stable market, a stable price. So that is the objective.
But for you, for PETROAN now, what would a sustainable, efficient energy supply market look like? What would it consist of? Also, considering that when you talk about imports, we have a shortage of FX, and that's going to squeeze it. So what would it look like for you, for PETROAN?
Well, for us, we are the last mile, we're the last critical mile in the industry. And everything that happens from upstream, midstream, to the downstream, it impacts on us. Because at the end of the day, we are the ones that are going to be taking the product that has been done by explorers, those who have oil blocks, those who have done exploration services, produce, taken to refinery, and then refine products. We are the ones that will ultimately deliver it to the masses, to the public, to everybody. And so our idea of what should be stable should be consideration of how the price volatility should be checked. So we don't just wake up and then we just hear that, oh, there's a price that has changed. And we do congratulate everyone for reducing prices, but we also have to check how this reduction of prices or increases of prices will affect the markets and the cost of capital and the availability of capital. If we do not have that, then it will be a challenge, for this very critical and important energy source, to be assessed by Nigerians.
All right, so would you say we're in a safe place now, before we let you, would you say we're in a safe place now? We do have refineries, at least 2 from NNPCL, we have from the private sector, we do have the modular refineries, and I hear we're still importing petrol. Is this how we should be going, or do you think something should be changed?
For us in PETROAN, we are very, very grateful to God and to all of the players. We are very thankful to Aliko Dangote for this very giant stride that he has brought. It's a thing of pride for me personally, because when I have meetings with South Africans, Ghanaians, Asians that are also in the retail space, because we do have our own meetings, it makes me proud to talk about the Dangote refinery. And also NNPC coming, those are our traditional partners for years, for decades. We certainly will keep working with them. And of course, new refineries are coming. AGOA refinery is popping up in Bayelsa, and we look forward to working very closely with that refinery and the gentleman who is making those sacrifices to put that refinery in the Niger Delta area. But having said that, we should still be able to have a liberalized trade where local production and import mix should be able to give us a competitive edge, to get products at a price that will be helpful in making our business to be much better. So we have advocated consistently that local refineries should be patronized much more. But if imported products that are of the top quality, that is accepted by the NMDPRA and Nigerian, are also coming into the play, we have really no reason to object to that. A couple of months ago, we made that decision to stop imports, and we supported it, but the times and climes and the methodology of the business today will require that all the mixes should be put into play. And we do encourage every one of us to this liberalized method of doing business, so that we have consistent energy security, and then we also keep aiming for affordability with profitability too. Because if we keep looking at just only affordability of products and of refined products, and then we do not think about the profitability, then we are going to stay out of business. And I think at the end of the day, it is also all of us Nigerians that will suffer that. So that's why we shouted out, and I believe that the government and the refiners and the depot marketers and the major marketers and the independent marketers and PETROAN members and other associations, Lugasa, all of us that are NUPENG, will be able to sit down as stakeholders and look at how this works. And don't forget that there's a stakeholder forum that is being headed by the Honorable Minister of Petroleum, Senator Dr. Eneke Lukubiri. And I believe that will do quite a lot in mitigating all challenges that will come. And that's why we came out with this advice on the system. And I believe it's going to help us to quickly address some of these issues.
All right, thank you so much, Mr. Billy Gillis-Harris, for coming out, of course, to air your view and stating out the position of your body, the president of the Petroleum Products Retail Outlet Owners Association of Nigeria, PETROAN. Thank you so much, sir.
Thank you so much.
Well, all of this is talking about the supply chain, logistics. Of course, petrol is not just for petrol, it's for transportation of both persons and products. Let's talk about that supply chain and logistics now and how it's affecting consumer goods sector. We have right here in the studio the plant manager from Cadbury, Mr. Owen Akinwande. Mr. Akinwande, good morning and welcome to the program.
Good morning, Hini, and thanks for having me.
Great. So we're just talking about the issue of petrol, and we've seen price drop. Dangote has announced reduction of price, and a lot of conversation of how this has fed into the supply chain. I mean, you deal with transportation, you move your raw materials to your factory. Has it been affected by this reduction in price that we've seen in recent times?
Definitely, and I think this is in the right direction because you realize that, of course, we make use of logistics as well. If the price of fuel is coming down, then definitely this is also going to impact on our total manufacturing cost and conversion cost, because there is an element of that also has to do with movement of our goods and all that. Even from raw material point of view as well, buying as well, there is also an element of that also has to do with the cost of transportation to our facilities. So, by and large, we also see that this is also then going to impact on our total manufacturing cost. So I think this is the right thing, and good to know that things are happening in the right direction in the country.
So talking about raw materials, with all of the things that Nigeria has gone through and all of that, there's been conversation of people or companies looking inwards to locally produce raw materials. Has it affected? Have we seen that in Cadbury in reality?
Of course, for us in Cadbury, of course, we are into the manufacturing of powdered beverage and candy confectionaries. Bonvita and Tom Tom be our major brands. And if you look at these, brands, the major raw material is sugar, which we source locally. And of course, even for our powder beverage as well, cocoa is a major raw material as well. In fact, for us, we are also into backward integration for cocoa powder manufacturing. We have a plant in Nigeria as well, where we produce is
so did you have that because of the FX shortage and the cost of production, or has it always been like that?
It has always been like that, especially for our backward integration. It has always been like that. I would say that probably we are more forward, thinking, looking at what could happen in the future, and that is the way we are modeled. We've always been having that backward integration for our cocoa and also for our malt. We also have a plant as well that produces malt, because malt is also one of our major ingredients in our powder beverage and also in our candy, in which we also source locally for all the raw materials as well.
Yeah, so talking about logistics, what's the connection from the farm? Because sometimes they say even though there seems to be high demand, the farmers still lose out of it because of the middlemen. When you look at the value chain or the supply chain connection of the farm to the factory.
Yeah, for us, we try to connect with the farmers, but we also make use of third parties that buys from the farmer, because dealing with a whole lot of farmers in terms of ensuring that they meet with our specification. So we have third parties that actually knows our specification, their quality, because the quality of the raw material is very key to us. So they actually understand our quality parameters and our specification, and they go to the farm, buy from the farmers, and ensure that they buy premium commodities for us. So we make use of third party. However, we also connect with the farmers in terms of training and building their capability, to ensure that they also farm such that it meets with our specifications as well.
Well, speaking generally, how true is it that Nigeria is losing out on a lot of export revenue because of the quality of our products or the processing of our products from the farm?
Yes, and that is where I think capability building comes in. I talk about also working. We actually have what we call a Cocoa Life program, where we partner, for example, with cocoa farmer to teach them about international standard, international specification, and how to ensure that they meet with that international specification. And I think a whole lot of body needs to do this as well, to ensure that whatever we produce locally can actually meet international specification. And I think we need to invest more in capability building for the farmers and training them to ensure that they meet that international specification. They can take advantage of the global global market.
Yeah, but can that be extended? Because, I mean, if you are going to do it, you're going to do it with just a handful. Do you think there's a need to expand that kind of a program? Because at the end of the day, we cannot depend on just oil.
Correct.
As a country, we need to look at agricultural produce. But if we cannot produce, I mean, I spoke to somebody who said they have to import corn to make popcorn in Nigeria because at the point of harvest or so, they're not processing it in a way that, will give a good quality popcorn. So is there a need for a national policy or program that would actually work with farmers widely in the country to educate them on the proper way to handle this?
Yeah, I think there are programs, maybe in terms of effectiveness of the program, there may be need for improvement. But I know that there are a lot of programs from government point of view and also from Manufacturers Association of Nigeria, partnering with farmers in terms of building their capability on global practices. Also, you see a lot of international body, they are also concerned about, protection for the planet, ensuring that your farming is not impacting negatively on the planet. So this is something, very big for international companies as well. So I know that this is happening in the country, but definitely there is need for improvement. And if a lot of companies as well, individuals and companies can also come in, like we are doing, come in to also train farmers, and I think that will be very good. We shouldn't leave this only for the government. A lot of body needs to come into play here.
All right, Mr. Owen Akinwande, Plant Manager at Cadbury. Thank you so much for your time.
Thank you so much for having me. Thank you.
All right, now we did tell you about Commonwealth Business Africa. They started yesterday, a gathering of women, interesting talks and interesting thoughts. Let's bring you a bit of it in this report.
It's the final day of CBW Africa Summit, and the platform is accommodating exhibition of goods by members to encourage and broaden market participation. Small businesses and their growth is part of the motivation for the summit.
Cross sectors to address challenges and seize opportunities. Empower women. Prioritize initiatives that support women's participation and leadership in all areas of development. Promote innovation. Leverage technological advancements to enhance sustainability and inclusivity in trade and economic activities.
The conversation is beyond small businesses. Tips for living and growth is the focus at the panel discussion.
People want to hear more of you, see more of you, do more business with you. And there's gravitas, which is the behavior. It has a lot to do with you, your integrity, your charisma, your confidence, your authenticity, your ability to inspire once again, your ability to have poise.
You have to be able to adapt to you having a product in your local market and being able to be flexible enough to change your packaging, your labeling, and how your product is made to meet the demand of the local market.
If I enter my factory, even the joy of the machine, that I can hear the sound, it gives me internal joy. I still train myself, and we should encourage our children to go into STEM education.
Women with outstanding performances and contributions to the summit and economy generally are recognized and rewarded.
Well, all of that ended yesterday for the women there. I guess what's left next is for them to practice what they have there. A lot of, motivational words came out of there, but they're just words until practice. Now, let's head to the commodity space now with Tether Kumeka and see what's happening there. Top on the list is that worrying price of Brent. So while it might come down to a more affordable petrol at the pump, it also means that the revenue of Nigeria would not be as much as expected at $68. But let's find out. Perhaps we can find a middle ground in all of this. When we look at the bigger picture, we can find a balance to it. So let's speak to Teva now. Teva Kumeka from Financial Derivatives Company. Hi, Teva. Good morning and welcome.
Good morning, Nini. Thank you for having me.
Great. Should we be worried now that we have Brent at about $68, $69?
Yeah, if you look at the benchmark for 2025 budget, which is around $75 per barrel, we should be worried because oil and we know crude oil is a major foreign exchange earner for Nigeria. So anything below that amount, $75 per barrel, is a headache for the government because it means lower revenue from the forex and a deficit in the budget. That's going to have a lot of impact on our revenue, and the budget funding means there will be more borrowing. So the oil price market is like a double-edged sword for Nigeria. A decline means that domestic pump prices will reduce, which is a good thing for consumers, those who buy for their vehicles and power their generators. But for the government, is a worry because the revenue, there will be a shortfall in revenue.
I guess we may be able to cover up.
Yeah, to cover, that means more borrowing, because if there's a shortfall...
No, I mean increasing production of crude. Increasing the production of crude.
Yeah, production has increased. We have about 1.58 million barrels per day now. So production will improve, but as the price of the commodity keep decreasing, the production will make up, but it won't make up to what the government has budgeted. So if production increase and the price keep going down below what the government budgeted, then the government will have to make for the shortfall by borrowing to fund its budgets.
Okay, and then we saw that the Naira, we saw under 1.5 most of last week, but now we see 1,570. Do we know what's going on there?
Yeah, the Naira is not yet out of the wood. We've seen Naira has been very volatile. From December last year, Naira stabilized to around 14.96 per dollar, but now we are seeing a depreciation. The cause of this is the drop in oil price, which forex has dropped, and then there is excess liquidity in the economy, which leads to higher demand for the dollar. So this demand is pushing, and the supply is not keeping up with demand. So the currency becomes very volatile and it keeps depreciating. So as we move forward, if there's not enough supply, then the Naira will keep depreciating. But with the CBN intervention, the Naira will be able to stabilize. But as we move forward, the foreign reserve is also depleting, because as oil prices drop and foreign exchange earning decreases, then CBN intervenes by stabilizing the Naira. The foreign reserve will keep depreciating. If as foreign reserve keep depleting, then the CBN will not be able to keep up with maintaining the Naira, so the Naira will keep depreciating.
Yeah, well, it looks like a cycle right there that we cannot break. We don't know where we're going to start from. I guess the solution will have to come from outside the circle, which is the non-oil sector. So, I mean, improving agricultural producers, as the conversation we had just before you came on. But let's see what's happening with the domestic prices, Teva. What's happening in that area?
Yeah, we've seen stability in domestic prices and some commodities coming down, and the effect of the the import waiver, the excess supply of commodity, and consumers don't have the purchasing power to get this commodity. So there's excess supply in the market, but demand is not keeping up because of cost of living crisis and stuff like that. Even though the official inflation rate has dropped, but purchasing powers of consumers has not improved. So as demand continues to decline and supply is in excess, then we will see prices keep coming down. But the danger of this is that as demand decreases, producers or farmers will not be encouraged to go into farming. So in the medium term, the price will decline, but as the incentive for going to farm drops, then the price will go back up again. So we'll keep going around the cycle. The important thing is to improve the welfare of the citizens and improve the business activities of farmers and other sectors so that demand will keep up with supply and we'll have a stability in all the sectors. But what we're seeing now with the domestic prices, there's excess supply, demand is low, because purchasing power is low, so prices are coming down. But for how long? If price continue to come down, there's no incentive for businesses to continue in that sector, then the demand supply will decrease. Then once there's shortage in supply, the price will go up again.
All right, thank you so much, Teva Kumeka, Research Manager at Financial Derivatives Company, for your time and views this morning.
Thank you very much for having me.
Let's take a break now. When we come back, global news will be up. Stay with us. Welcome back. Still Business Morning right here on Channels Television. We head to the global space now, see what's making top news with global economy and corporates. Will Ibong is here. Will, been a while since we had you in the morning.
Oh, yes,
should we, let's say pop champagne?
Pop champagne.
Oh, no, but this is, yeah, so it's too early for that.
It's too early.
Yeah, we'll probably head to the NGX and
do the closing.
Exactly. Good to have you in the morning, Will.
Thank you, and it's good to be here.
Yeah.
We've seen Japan's GDP, growth. The government revising their GDP growth, and so much is happening, but let's just take that as a first.
Yeah,
story.
well, I mean, myself and Ladi have been talking a whole lot about tariffs, and it seems once you look outside Nigeria, the news that hits you from investors to corporates and markets is all about the tariff.
It's all about the tariff.
I don't think you will escape it too.
Well, I actually wonder, where is Africa in all of this? Where is Nigeria
we're good.
in all of this?
We're good.
Are we good?
So what we're doing is we're just watching to see the signs and where we can take advantage. Hopefully.
I like the optimism.
We'll plug in all of that. When the big elephants are fighting, then we can come in and supply to some of those big elephants.
Because I usually hear that when the elephants are fighting the grass,
nah, we're no grass.
Okay, great. We're no grass in the mix here. Now let's talk about Japan's economy. We see that it grew by 2.2% in the fourth quarter, and that was lower than the initial 2.8% estimate as weak domestic demand persisted. Now, quarter on quarter, the growth stood at 0.6%. That's slightly below the previous 0.7% figure that came in. That's also now complicated the Bank of Japan's decision on raising interest rates. Now, while the central bank is expected to hold rates steady at its March 18th to 19th meeting, that's next week, policymakers may consider a hike by May, and this is due to rising wages and food costs. Now, meanwhile, Japan's Nikkei 225 dropped. We see the yen strengthening, and we also see bond yields dropping. Now, but let's look at other matters now. Inflation in the country is exceeding the BOJ's 2% target for 34 months now, and analysts, as I mentioned, are anticipating further rate hikes this year. But the Bank of England so far has raised interest rates to 0.5% in January, and that's the highest since 2008 as it continues to scale back its ultra-loose monetary policy. Now let's look at Australia now. One of the world's largest gas exporters may soon have to import liquefied natural gas, that's LNG, and this is due to infrastructure and supply constraints. And energy analysts are warning that despite ample gas reserve in Queensland, pipeline and storage limitations could lead to shortages in the southern states by 2027. Now, New South Wales, Victoria, and Tasmania are all already facing winter supply concerns. Now, this is raising fears of another energy crunch that we saw in 2022. Experts predict that LNG imports are becoming inevitable. That's unless major infrastructure improvements are made. But we see that energy policy is set to be a key issue in the upcoming elections in the country, with Labour pushing for 82% revenue energy, while the opposition, they're advocating for nuclear power. Meanwhile, companies like Squadron Energy and Viva Energy are proposing LNG import terminals to ease the crisis in the country. Let's zoom in now. Germany's Green Party is saying it's set to, it's open to negotiations on defense spending. We know why this is happening with Chancellor-in-Waiting Friedrich Merz's coalition, and it's hoping for a deal by the weekend. We hope that happens. Now, co-leader Franziska Brent now is stressing that the need for Europe to accelerate military funding amid this Ukraine crisis. We're hoping that happens as well. Now, talks began on Monday in Berlin, with the Greens demanding stricter spending rules, and their counter-offer signals room for compromise as Merz pushes for massive economic investment. The euro, we saw the reaction of that. It rose 0.3% following the remarks. Now, the Green Party is opposing the 500 billion euro fiscal plan, calling it a political move rather than a defense strategy. And Brandner is criticizing the proposal for lacking intelligence funding and Ukraine aid, insisting on reforms before approval. Still in Germany, German autos giant Volkswagen has reported a 15% drop in annual operating profit, blaming higher costs and restructuring expenses. However, we saw revenue rising slightly to 24.7 billion euro in 2024, and the company expects up to 5% growth in 2025. Now, despite this 3.5% decline in vehicle sales, Volkswagen is calling the results solid in a tough market. It forecasts an operating margin of 5.5% to 6.5% this year, down from 5.9% in 2024. The company plans to cut dividends, that's a big one, by 30%, proposing €6.30 per ordinary share and €6.36 per preferred share at its annual meeting in May. Now I'll go to the big juicy story here. The U.S. says it may strike a deal with Canada to avoid tariffs on oil, gas, and other energy imports. Energy Secretary in the U.S., Chris Wright, said on Monday. And while the possibility exists, he is noting that it's too early to say. Now, the U.S. is in active discussions with Canada and Mexico, as President Trump has temporarily paused tariffs on their energy imports until April the 2nd. However, it remains unclear how much of Canada's energy exports comply with the USMCA's trade agreement. Canadian Energy Minister Jonathan Wilkinson has warned that full tariffs would drive up U.S. energy prices. Wright stated that any agreement must be reciprocal. But we see that Ontario's Premier in Canada, Doug Ford, is not waiting for that, because he has announced his own tariffs in response to U.S. President Donald Trump's tariffs against Canada. Now, Ford announced a 25% surcharge on electricity exports that will take effect very soon, but will affect 1.5 million homes and businesses across Minnesota, Michigan, and New York. Ford said it does not want to do this, but will not hesitate to increase the charge or to shut off electricity altogether. But we're seeing these tariffs and trade wars going on around, and as I mentioned with Ini, how does this impact other countries, especially Africa, this continent? We're seeing that this recent, we see also for South Africa, look, just coming down to Africa here, U.S., made a decision to halt federal funding to the country, and it's part of its broader context of escalating trade tensions and geopolitical disagreements. We saw last month that Trump had already signed an executive order to cut all U.S. financial assistance to South Africa, and citing disapproval of its land policy and of its genocide case at the International Court of Justice against Washington's ally, Israel. Now, to discuss this and unpack more, Lara Wolf, senior country analyst at BMI for Sub-Saharan Africa, joins us this morning. Good morning, Lara. It's good to have you on the program. Lara, on Friday, U.S. President Donald Trump said that his country, not that he's saying it, he's reiterating that his country is stopping all federal funding to South Africa. How has the South African government responded to this decision, and what measures are being considered to mitigate the impact of the funding loss?
Good morning, and first of all, thank you so much for having me on the programme. In terms of the South African government's response to the overall worsening at the moment of South Africa-US relations, I would characterise it as pragmatic but firm. So firm in the sense that we've seen President Cyril Ramaphosa state in his State of the Nation address in early February, we will not be bullied. More recently, the South African government has said that they will not take part in what they have called counterproductive megaphone diplomacy. So they are standing firm. However, there is also pragmatism. The South African authorities are cognizant of the fact that the US is South Africa's second largest trading partner. So we are seeing the South African government pursue progress in terms of diplomatic back channels. We also know that the South African authorities are preparing an official delegation to go to the US later this month. This will be led by the Trade and Industry Minister with an attempt to reset South Africa-US relations. We've already seen mentions that South Africa could offer the US more access to gas exploration in South Africa. Potentially in return, South Africa may offer to source more of its gas from the US. There's also been talks around South Africa leveraging its mineral and metals portfolio. On the federal funding, which you mentioned, we've seen some interesting statements from ministers. So the Minister of International Relations and Cooperation has said that South Africa must seize the moment, and this is a catalyst, use this as a catalyst for change. And this has been echoed by South Africa's Health Minister, who said that the federal funding cuts were a necessary wake-up call for self-sufficiency. The healthcare minister has pointed out that 90% of South Africa's antiretrovirals are currently funded by the national budget, with only 10% supported by international donors. However, he has also acknowledged that federal funding supports significant numbers of healthcare workers and NGOs, and this would largely be cut. It's an interesting time, of course, because we have the South African budget, which is expected to be announced tomorrow. So we will be looking to see what resources are potentially reallocated to the healthcare sector. But given South Africa's limited fiscal space at the moment, so South Africa's budget was meant to be announced a month ago, but it has been delayed because of disputes over how to raise revenues within the country, with parties within the Government of National Unity disagreeing with the finance minister's efforts to increase the VAT by 2 percentage points. So if we look at the fact that South Africa is struggling to raise revenues, then it must come from, if they are hoping to sort of cover the costs or cover the US federal funding cuts, it must come from reallocating resources. Okay, Lara, we see that relations between, you mentioned, with US, South Africa is already strained, and you look at the last G20 meeting, the US snubbed South Africa, did not attend that meeting. But let's look at AGOA now, that's the Africa's Eligibility for the African Growth and Opportunity Act. How might the suspension, you talked about the budget, but in the broader economic consequences now, what will be the potential economic consequences if AGOA, the benefits of AGOA were revoked as a result of this aid stoppage? So the main fear around AGOA is the auto sector. AGOA exports only account for 20% of South Africa's exports to the US, but over half of South Africa's around half of South Africa's exports to the US under AGOA are vehicles. And therefore, that would likely be the sector that is most hit. The automotive industry accounts for around 3% of South Africa's GDP. But when we think that this is not just the autos industry, but also industries reliant on the auto sector, such as rubber, manufacturing, and logistics sector. So autos is what we're highlighting as the main risk. However, there are also other sectors that would be negatively impacted should South Africa be fully removed from AGOA, because South Africa could retain its AGOA access. It could see a partial removal of its AGOA access, or it could be fully removed. So should it be fully removed, other sectors that would be impacted are, or other exports would be fruit and nuts, particularly citrus, beverage exports, as well as some apparel and clothing exports.
And so definitely we'll look out to see how South Africa, maneuvers and, stays strong in the face of, this economic tension that is going on, and especially with relations with U.S. training, hoping that the country does not face any more challenges. Thank you so much. We're running out of time here now, but Lara Wolf, thank you so much for your time. Lara Wolf is Senior Risk Analyst, Senior Country Risk Analyst with BMI. Thank you so much for your time.
Thank you for having me.
So, that's the much we can take, especially now the tensions. You see what is happening in South Africa is already trickling down, impacting on their aid and funding, and the budget is seeming like, man, it's not really looking so great.
But Will, it's not just about South Africa. I mean, Canada is dealing with it. Europe, they also have their own. I think
they are able to retaliate. How are we retaliating?
Well, we retaliate by taking care of ourselves.
Okay.
I mean, Mrs. Okonjo-Iweala had said Africans should actually take care of themselves.
True. We have the potential. We hear about these potentials, but how can we actually make the potential a reality? More like follow through with policies. We don't lack those. Follow through, execute, and make sure that Africa.
And we have the resources.
We do have the resources.
So it's for us to use it. And talking about AGOA is expiring in September anyway. And with the way things are going, it doesn't look like President Trump is going to renew it. So whether South Africa is removed now or not, Africans take care of themselves. Whether it's South Africa, whether it's Nigeria, we just need to take care of ourselves.
Definitely.
Look inwards and then, explore our potential.
Like you said, we'll be the ones to come out shining,
Amen. All right, well, thank you. See you at Business Incorporated for the market. And talking about the market, just before we head out of business morning, let's tell you how it closed back here in Nigeria. The first positive in a while. Okay, we had a positive in Thursday last week, but that was almost forgettable because it was so minute. Yesterday, we just about 50 billion added to the market cap, but at least we saw the bull come out, and there you have it, 106,621.91. Equities cap still around 66 trillion, 66.769 trillion. And oil and gas, we saw a lot of profit taking last week on some of those stocks. They led that positive move yesterday. Eternal Oil topped that. Eternal Oil yesterday gained 9.96% at the close of trade, and then Transcorp followed, and FCMB. The financials, they always find their way into all of the good news. Their top losers yesterday: VFD Group, Intense Insurance, and Cadbury. We spoke to Cadbury earlier today. They were part of the top losers yesterday. Top trades were financials, Fidelity, Access, and Zenith Bank. So we can say they contributed majorly to the market. Look at the smaller unlisted markets for yesterday. It was also positive. They've been keeping some positive trends, just our eyes are not always there. So if you're an investor, you might want to look the way of the unlisted market. We know that Arador, for instance, moved from here to the major market, and some investors made some money. So there you have it, 0.65% in the positive, 3,392. I still remember when this market was struggling with 1,000 there, but I mean, they're looking good. 1.96 trillion is their market cap at this time. And you have for their volume, it was all positive for their volume yesterday. Volume was up more than 53%, value up more than 26.9, 36 deals, more than 157% of on stocks traded yesterday went up by 120%. So if you are an investor, you have some funds you want to grow with, you may look the way of the unlisted market. It could be of good to you. But that's the much we can take on Business Morning today. Thank you so much for being a part of it. Business Incorporated, of course, will keep you updated at 1 p.m. You don't want to miss it. We'll take you around the world of business, markets, and all. That's at 1 p.m. Amini John Mekwa. Do take care.
Fly better.